And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the Hump Day edition of The Real Investment Show. Welcome. Glad you're here, of course, as we continue to grind through this kind of holiday shortened week. Again, markets just kind of hanging in here right now. Economic news is going to become a little bit less exciting this week. But next week, we have the inflation report and then, of course, the Fed meeting coming up. That's going to be kind of all eyes focused on that. But employment is one of the interesting kind of things that's going on right now because, again, we continue to have these fairly strong job reports. And but doing a little bit of analysis and kind of looking at the job situation may not be as robust as, well, maybe headlines make it out to be, right? Everybody's been very excited about the jobs reports. Again, we're producing new jobs. That's great, right? We're doing that. But also remember that there's two factors about creating jobs that's very important in the economy. So first of all, we have population growth. So we grow the population every month, right? We have new entrants into the population either through immigration or natural birth. And then, of course, that population grows over time. So you have more as people start to enter the workforce. Every month we have new people entering that workforce. So we need to create jobs to absorb those new entrants into the workforce. So every month we need to have a set of jobs open available for people entering the workforce. So that's one part of that. The second part, of course, is keeping everybody else employed that was employed. So, we have a lot of kind of misnomers in the media right now talking about, we've created 189,000 new jobs this month or whatever, right? So did we really create 189,000 new jobs, or are we still replacing jobs that we terminated back during the pandemic? So if we look at job growth pre-pandemic, right, there's a trend of growth over time, right? So we need to create new jobs to absorb new labor entrants into the markets because of population growth. So there's a consistently rising trend of jobs needed, right? So we're still below that previous trend. In other words, we're still trying to play catch up to what we lost during the pandemic plus the job growth. So yes, we are creating jobs. Jobs are growing, absolutely. But we're still below where we should be in terms of where we were in growth of jobs pre-pandemic. So that's one side of this. The other side of this is also very, very interesting. Once you start kind of digging down into the numbers, we start finding out that each job report this year, the previous jobs report was revised down. And so, of course, now we revise jobs just like the economy, right? So when we have GDP reports, right, we have the initial GDP report, then we revise it 2 more times to get the final GDP number, right? So at the end of each quarter. We do the same thing for jobs. There's 3 estimates for the jobs report. So every time we report jobs, then we look back and we revise the other jobs. We do that 3 times. The difference right now between the third estimate and the first estimate of the jobs is the most negative that we've had really since the financial crisis. In other words, the previous downward revisions in jobs. Now, we don't pay attention to those revisions, right? When we get the jobs report, we all go, hey, we created 180,000 new jobs, but we don't really pay attention to the fact that we revised down all those previous jobs since the beginning of the year. So we haven't created nearly as many jobs as it looks like. But importantly, we have now the biggest spread, negative spread, between the first estimate and the third estimate that we've had since the financial crisis. In fact, that spread is a very recessionary indicator. It's an early warning sign. And in fact, every time you have this kind of negative spread between the first and the third reports on these estimates, it is typically preceded the onset of a recession. Now, I'm not making a recession call here, right? I'm not saying that. But what I am saying is this is just another one of those mini indicators, right? So if we take a look at the mainstream media right now, they're all like, hey, absolutely no chance of recession. Goldman Sachs just revised down their chance of recession from 20% to 15%. So they're saying no chance of recession. But yet we continue to have more and more of these kind of data points that suggest the economy is still heading towards a recession. So again, we've talked about before is that, look, the monetary conditions are very tight, and that's going to weigh on economic growth and earnings. And so there's a dichotomy right now between what's happening in the financial markets versus what's happening in the economy, and more importantly, what most likely will happen as we get into later next year. So again, you know, when you just take a kind of a sum of all of the data out there, the risk of recession certainly has not been put away. And I think we have to maintain a view that the risk of a recession sometime next year is certainly possible at this point, unless there's some type of massive monetary infusion from the government. Again, these student loan payments set to start on October the 1st is going to be about a $150 billion drag on the economy. So again, it's not small. It's not small at all. So just kind of keep this in mind, so we're looking at. Okay, let's talk a little bit about what you need to know before the bell this morning. Markets are doing okay, right? Yesterday, markets were down a little bit. Interest rates were up a bit because of oil prices, not surprising. But again, markets just really kind of doing, well, what they do. And, you know, we continue to kind of be in this correctional period here, August, September. Markets are responding very normally to all that. One of the things, though, that is kind of interesting is looking at the volatility index, which is very, very suppressed right now. Volatility, not surprisingly, has picked up over the last couple of days because of the choppiness in the market. But again, volatility as a whole is very suppressed relative to where we've been historically. And, you know, importantly here, as we take a look at volatility, yes, there's certainly some impact from these 0-day to expiration options. There's been a large chunk or change in the options market to where people are day trading these options that have less than 1 day to maturity. In fact, they make up more than half of all the option trading every day. So there's certainly an impact about that. And there's kind of some theories that this is really kind of suppressing the overall volatility index, and that may very well be the case. You know, I don't have any anecdotal, evidence of that just yet. But what I do suggest here is that, you know, this volatility is very, very suppressed here. And basically going back to this, you know, investors have really no fear of a correction or something in the market. And that really is the case. If you talk to most investors, they're like, yeah, market's great, it's doing fine, it's only going to go up from here, we're good. Markets are back. No worry about a potential recession or anything else that might occur that would impact stock prices. The volatility index is kind of confirming exactly that sentiment. Now, here's the interesting thing about this. So when we start talking about volatility at these very low levels, volatility over the past, decade has had periods of these very low readings before, and they all do eventually end, and they eventually end with a bigger market correction at some point. What triggers that, I have no idea. But right now, if you take a look at where we are in terms of the yields on markets, right? So the dividend yield across the entire index is at a very low level relative to where it should be in this type of a market. And with volatility at these levels, it suggests that yields are going to be higher in the future. And this particularly dovetails with the fact you have very low volatility, very high valuations, very low yields. You start putting all those together, what that suggests is that yields are going to rise on stocks at some point over the next year. And that's historically the way that this has worked out. So how does that happen? Well, in order to correct valuations and get yields up, stock prices have to go down. So the question is when does that happen? What causes that to occur? I have no idea, but volatility continues to be one of those measures we want to watch because that's kind of an early warning signal. If volatility starts to rise, that is going to give us good signal of potentially the risk coming in the markets. That's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff, 7 investments that maybe you want to avoid. We'll talk about that with Danny Ratliff right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. Danny Ratliff joining me this morning. Drug himself out of bed early.
Somebody had to do it.
Brent coming in hot this morning. He overslept. So,
See, that's not real common.
that's not real common, but it's been twice lately. Which what's going on with your alarm clock at home?
Maybe time to get another one. I don't know. I don't. It's hot.
Yeah.
I did a lot of work outside yesterday.
Yeah.
Went to bed exhausted.
That'll do it.
I called Brent last week and said, hey, I'm not sure I'm going to make it. I'm on my way. Got here in time.
So
I know how it goes. Feel the pain.
Every morning, Brent leaves me these little tidbits on my computer I tell you about from time to time, and he left me this one this morning. That someone from, and let me just tell you the why this made me chuckle, because my wife has an ongoing battle with anything with the Ziplock on it. She cannot, for her life, operate a Ziplock. And I don't know why this is, but I will tell you how I know that she's been into something that has a Ziplock, like cheese.
Yeah.
Has a Ziplock top. I will know that my wife has been into the cheese because she will have cut the top off the bag entirely. Because she can't open the Ziplock and she can't get it to shut. And I don't know if this is like a mental hangover from something that happened to her as a child. I don't know what, but there's this ongoing battle between her and Ziplocks. But so this made me chuckle this morning because the Brent put on here says, if someone from Ziplock could contact literally anyone in the cereal business, that would be great. And this is a true fact because, when you have kids growing up, and I don't know if Danny's are old enough yet, but once that they're getting their own breakfast and everything every morning, you will find cereal bags open and everything's stale. So, it's completely a waste.
There's nothing worse than stale Cheerios.
Yeah. Well, I'm convinced they do it intentionally, though, because then it makes it difficult to actually get a proper pour, like when you're pouring them out of the bag. So stuff just goes everywhere. It comes out and like, oh, well, you got to buy more.
Yeah. Probably the case.
Yeah, that's funny that we actually had a conversation with our middle one. He's been giving us grief on food lately. Doesn't matter. You could cook his favorite meal, and he's like, this is terrible. And my wife it drives her bonkers.
Right.
Which me too. I get it. And he's being a stinker for whatever reason. And so I said, you know what? They had a blowout yesterday. So I said, I've got a little bit of time. I'll make some phone calls and sit in line and go pick him up. And man, he got in the car and said, hey, bud, we need to have a talk. And he said, yeah. He said, looks like I'm going to start making my own breakfast, lunch, and dinner. I said, amen. Yes, you are. So he's about as stubborn as she is. So
Yeah.
I'm waiting to see who's going to win this one.
Well, my wife's always threatening to come back after she passes away. She's always threatening to come back and haunt me. I just figured out I'm going to bury her in a Ziploc bag.
There you go.
She'll never get
She'll
out.
never get out.
So,
Oh, man.
anyway, she's probably going to come back to haunt me after the show this morning. Anyway.
Nice earn, Mr. Roberts. Yes, it's Ziplocked.
So 7 investments that, well, before we get into that, a couple of other quick tidbits, and we'll get into this. I'm going to give this segment some time because there's a lot to kind of dig into. So, one of the things that, we were talking about earlier in respect to the markets is, again, there's this overall riding sentiment that, everything's fine. Right. I was on Charles Payne yesterday on Fox Business, and, he led off with the question, right, is like, there's everybody's convinced there's no recession coming. Right. And this has really kind of become the base case, is that we're going to avoid recession and everything's going to be fine and market's going to go higher from here. And again, this is why the VIX is very suppressed right now, because there is no fear in the overall market. And as we talked about before, this is the interesting dichotomy of things, because last year everybody was expecting a recession and markets were declining because everybody was expecting a recession. It didn't happen. And so now everybody just assumes that the recession isn't going to occur, but yet it's not just one indicator here or maybe one random kind of indicator over there. There's just more and more indicators that are now piling up that suggest the recession risk is fairly elevated. And I was just talking about the spread between employment revisions. We've had negative revisions on employment every single month this year. We don't pay attention to those revisions, but what it tells you is that the job market's a lot weaker than it actually looks like, which also explains a lot of other things.
They revised it down by 111,000 jobs?
Yeah, and 350 since last year.
Wow.
So, but again, the spread in revisions between the 1 month and the 3 month is the most negative since the financial crisis, and that negative spread only occurs pre-recession. So you have that. You have the NFIB surveys, which are very in recessionary territory. You have the leading economic indicators in recessionary territories, the yield curve in recessionary territory. I mean, just there's just so many numerous indicators, and many of these indicators have virtually perfect track records for predicting recession. Could this time be different? Absolutely. Not saying that it can't be different this time. Could we avoid a recession? Absolutely. It just seems to be, though, that people have become uber complacent in this idea that you're not going to have a recession, which actually now provides the basis to actually have a recession from a contrarian basis, right? Just as Bob Farrell once said, when everybody expects something to happen, something else tends to occur. Right now, everybody expects there to be no recession. So just something to kind of think about.
Well, and Goldman as well comes out yesterday and says, hey, what they reduced their recession risk indicator or expectation to 15%.
Right, from 20. And again, but they're well below the consensus estimate as well.
Yeah.
So there's and even the kind of Bloomberg consensus estimate is still fairly low. It's like 30%. So that's down from nearly 100% last year. So it's just the point here is that I think that you just can't take your eye off the ball right now from the standpoint there's just there is risk, and I'm not saying that means go sell everything and go hide out in a bunker somewhere, but I just think you have to pay attention that there is some risk as we head into next year, and particularly as these student loan repayments start in October. That's going to be a hit to the markets. Every month we come out and we have all these people talk about, well, there's all this excess savings, which is declining, right? These excess savings that we have, I don't know how they actually calculate that, because the people with money, the top 10%, they have a lot of savings. We can go look at the bottom 80%, they have nothing. They're living paycheck to paycheck. There's a big dichotomy between the top 10% and the bottom 80% of the economy in terms of finances. So, but even with that, though, if you just assume this bottom 80% is already struggling, what's going to happen to spending when they have to start making these payments, right? And I just think that's one of the risks I think that a lot of people are just really kind of grossly overlooking.
Yeah, and I think it's easy to do. I mean, when you think about the environment that we've been in, you're coming out of the pandemic, people say, hey, we're going to spend. And, it has changed from a normal type of recession than what we would historically see because we've never had this amount of stimulus. It's just unheard of. So I think it is different in many ways.
Right. Well, and I think it's going to be interesting, too, because, as we come out of this, and, we're going to learn a lot of lessons from this. And, going into this, and we were writing articles about modern monetary theory and the fallacy of modern monetary theory, going into the financial or into the pandemic situation. And, everybody was like, oh, no, MMT's great. And of course, now we find out that it doesn't really work as planned because it creates inflation. And, as always is the case, we go back and we look at John Maynard Keynes, and he said, look, during a economic recession, the government should step in and start spending money, right? Deficit spending during a recession by the government. All people heard, or all politicians heard, is, oh, spend more money. That's all they heard. They didn't hear the part from Keynes that said, after the recession is over, you go back to a surplus and prepare for the next downturn, right? Never heard that. We just, once they latched onto this idea of spending money to avoid deficits or to avoid recessions, then deficits just became a thing. And we were okay with that. And modern monetary theory says the same thing. Is like, hey, send checks to households, that's fine. But as soon as you have inflation, raise taxes. We didn't raise taxes.
Well, not yet.
Not yet. But again, nobody wants to raise taxes either. You don't get elected raising taxes.
So what about now with the Treasury having to issue so much more in debt with bonds? At some point, we're going to have more demand than supply, and rates are going to increase?
No.
Because
it's always a place where you store capital.
Yeah.
At the end of the day. So, and this is always a function, and this is always kind of the misnomer of a lot of the the markets. Inflation is a function of economic growth. Interest rates are the calculation against economic growth and inflation. So interest rates can't go up if inflation and economic growth are going down.
Yeah.
Because it's all about what you're going to lend money at. And I lend money based on what my expectations for economic growth and inflation are. So and this is people think that there's this, there's kind of this idea of these bond vigilantes, and they're just going to show up and nobody's going to buy bonds. Well, you've got to store capital somewhere, and it's not going to be in the stock market when the stock market's going down, so money's got to go to somewhere. But the second thing is that the theory of bond vigilantes is fine until you have government intervention. And so as soon as you start having a problem, who's going to show up and start buying bonds?
Uncle Sam.
Yeah, the Federal Reserve or every other central bank on the planet.
Yeah.
So you don't have a free market. You don't, and this is funny because everybody says, well, we don't have a free market economy anymore, right? Because the government is so involved in everything, right? We don't have a free stock market because we have, all this government intervention. But somehow they think that there's a free market in bonds. Come back after the break. Pick up with 7 types of investments you should avoid. With Danny Ratliff. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The bets are on right now for the NVIDIA drinking game.
The Real Investment Show podcast.
Every time NVIDIA says the word AI, you have to take a shot.
Same show, your schedule.
By the time they get through the earnings call, half the country will be completely obliterated and it really won't matter what they say their earnings were, which will be just in time for the debates. Exactly.
At realinvestmentadvice.com.
That's a whole other drinking game right there.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So 7 types of investments clients should avoid. And you know, this is always kind of an interesting topic, and because there's so many people that have different opinions about these things. And this is kind of, so I just want to clarify that this is in general. These are 7 types of investments that you want to avoid. And the reason is that for most people, it really comes down to the analysis and the experience of these investments, and we'll kind of nail them down one by one here. But Danny, just kind of your thoughts.
Well, I think it also comes down to kind of your emotional fortitude as far as what you can handle, and then also understanding that, okay, maybe I can use this type of investment, but you're not going to throw everything you have at it, right? It's maybe in bits and pieces, and understand exactly where that fits within your portfolio, your goals, objectives, and so it's very subjective, like you mentioned.
Right.
But came across this article and I thought, this is really interesting because there's some that I really agree with.
Right.
And there's a couple I'm like, that doesn't make as much sense.
Right.
Right. So very subjective. But number one, speculative assets. I think that, we get into environments, especially when everybody feels like maybe at the moment where people feel like, yeah, you know what, there's going to be, the market can do no wrong. Or, we talked about this the other day, that there's that insurance policy with the Fed that's just waiting, or fiscal and monetary policy to come bail everybody out here at some point. And so I think a speculative asset, number one, you need to understand and determine what is truly speculative, right? I mean, markets in general are speculative.
Right.
But like you mentioned, doing analysis, understanding exactly what the drivers behind it are, exactly what these guys have maybe in their pipeline, what their business looks like, understanding fundamentals, 4-letter word here lately. At some point that'll come back.
Well, and again, when you're talking about, I guess, you have to kind of define what you mean by speculative investment. But
correct.
but if you're thinking about taking a flyer on some new up and coming company, right? It's like there's a company. It's and again, we see this a lot with penny stocks. There's a lot of pump and dump schemes for penny stocks, and they tell you, oh, this company is going to have the next big invention that for healthcare, and as soon as you get FDA approval, this stock's going to go taking off to the moon. And so people will pile into this and not really understanding that a vast majority of drugs and things getting applied to the FDA ultimately get rejected. So these companies will go from boom to bust very, very quickly. And again, there's nothing wrong with speculating in the markets as long as it's done with the appropriate risk management. The problem is that most people don't understand, they're going off a news headline, but they don't understand all the underlying risk that's involved with that. And potentially that's going to mean that you could lose some, most, or all of your money. And then when that happens, then they're shocked that happened.
No, what happened? I mean, we had so many good things behind it. This guy said it was going to do so well,
Right.
or my neighbor. I mean, there's so many different, things that you hear about this. And so with any type of speculative investment, you need to be cautious. I use this analogy quite a bit. Do you remember back in the day, Iraqi dinars? Mm-hmm. And so I was getting calls. This was like right after, this is mid 2000s. And I get calls from people. They say, hey, Danny, I'm about to come into a lot of money. Great. What happened? Where'd it come from? Is it a settlement? Did you win the lottery? I can't tell you about it.
Yeah.
Okay.
Oh, no, it was a huge scam. We were on the radio show talking about that ad nauseum because people were calling up and going, I've got all these Iraqi dinars, and as soon as they, issue as soon as they convert, back to this, these are going to be worth, millions in dollars. And I was telling everybody back then, it's like, look, when a country goes through what Iraq went through, if they did install a new government, the first thing they're going to do is wipe out the old currency and issue new currency. So, I mean,
well, it was already wiped out. They devalued it. And so essentially what they were going to do is they were going to come back and revalue the Iraqi dinar. There was information everywhere, right?
Right. That's the whole thing, though. But they were never going to do that.
Yeah.
And I mean, the whole premise never made sense, but it was a huge scam. I don't want to get off on this because we're going to get off on
a whole different tangent. But what I want to get to is that a lot of times, so my question to them, once you find out what it really was, is like you find out that people they took home equity out, they took the retirement and cashed it out and bought all these. I said, well, okay, when is this going? Well, Danny, you don't understand. These guys are so smart. You wouldn't understand. Well, then how come you understand? This is what I do for a living. Hang on. So what is it that I don't understand? So finally I said, well, listen, all right, this is going to be revalued this next week. Will they sell you more? Well, yeah. Okay. Well, if it's going to revalue, it's going to be worth all this, why would they sell you more? Well, because they're good people. Well, then why don't they give it to you? Because they already have so much money. And so I know this is probably a really touchy point with somebody out there, and I'm sorry because I know this is terrible.
But the point is that whenever you hear about something, especially on social media these days, about some type of investment,
we didn't even have that back then,
right? Yeah, just be aware. Speculation usually means that you're going to lose all your money, right? So always think about a speculative bet. If I'm going to do this speculative bet, how do I equate that? That is the same thing as going to Vegas and betting on black. You're either going to win and win big, or you're going to lose and lose it all. That's just that you should approach every speculative investment that way. And if you're not willing to lose it all, don't do it.
Yeah, and so listen. I mean, I understand that there could have been significant upside there. I mean, Lance just mentioned, there's the likelihood of that happening is very, very small.
Right.
And so we always want to take it in small bits and pieces when we're looking at anything that's speculative. Make sure you have a good understanding and just don't get talked into something that, if you're being sold that's when I'm always like, flashing red lights start going off.
Right.
Like, whoa, hang on.
I get a lot of emails from people and they're like, oh, I just got offered this real estate investment deal.
Yeah.
Right. And I'm going to make, 8% on this investment deal. It's this piece of real estate. This deal looks really great. First question to ask yourself, why are they offering it to you? Right. Ask yourself that question. Why are you so lucky that this company is offering this investment to you? Because if the deal was really good, and I deal in these things all the time, if the deal is really good, it's bought up by an institution immediately. Because institutions have more money than they know what to do with right now, and they've got to get it invested. So good to mediocre deals get absorbed by institutions very quickly. You'll never see them. So if you're seeing an investment deal that somebody's bringing to you, it's the bottom of the barrel most likely. It's the one that nobody else wanted to fund. So that's always the way to look at it. And that doesn't mean every deal is that way, but the vast majority of them will be.
Well, so that's a really good point. Leads to the next one, real estate investment trust. And while these can be very good in certain environments, in an environment like we're seeing right now, where we have rising interest rates, granted, I mean, the pandemic, nobody could have anticipated what that would have brought in the sense of office vacancies. I mean, you and I have talked about this forever, though. Like, I drive down the road in the middle, early in the morning, and you drive by these big office buildings, they're completely empty, and they're building a new one right next to it.
Right.
And so I've always had some speculation or hesitancy about that over the last, several years. But this is one where, with vacancies and with the anticipation, most of these real estate investment trusts, they have to refinance after a specific period of time. If you're refinancing at higher rates, you have tenants that have moved out. Now you have hybrid work, all these different scenarios that we did not have previously. This can be problematic. And so, like Lance said, if somebody's not going to go and scoop that up, a big institution, they're coming to you and offering you I saw one the other day, Lance, where we had a client who had one from a previous advisor, and they came back and they said, we will give you 24%. They cannot find a loan.
Yep.
These companies cannot find anybody to give them a loan. The office space is devalued, the building.
Yeah, let me just clarify one thing. We're talking about private real estate investment trust, right?
Correct.
So versus publicly traded REITs. Publicly traded REITs are a different story. You can buy one and sell it tomorrow, no big deal, right? Because it's just all it is a stock in the real estate space. That's all it is. So that's just a stock. What we're talking about here is these private real estate investment trusts. And there's two things you got to really understand about this. One is that, again, go back to our previous premise, is that if they're offering it to you, why? That's the first question to ask yourself. Second thing is liquidity. Back in 2000 and around there was a financial radio program that was, on the show, and they were talking about this real estate investment trust, and they were putting all their people into the trust. And they think, this thing's going to go public any day now. 23 years later, it still has not gone public, right? And these people are locked up in that real estate investment trust. So again, liquidity is another big issue. When do you get your money back? And that's the first question. First question you ask, why am I so lucky, and when do I get my money back? And remember that all these things that real estate investment trust offer is a pro forma. That's like, man, if I fill this thing up and I can charge everybody this amount of rent and all this happens, we're going to make so much money. Those are always the most optimistic assumptions. You always have to cut those down by 30 to 40% to get to what reality is going to be. So again, don't invest in private real estate investment trusts or private investment deals, period, unless you really know how to do the analysis, understand what your liquidity is, and understand what your risks are. Yeah. And again, lastly, ask yourself why you're so lucky to get the deal.
Well, and even that, we have some very wealthy clients that, I always love to learn a lot from them and pick their brain, because they've been there, done that. They've accumulated wealth over the years. And many of them will put the bare minimum in any of these types of investments because they know the risk. They've been through it, but they also know that, hey, I may hit a home run that's going to offset me losing money in these areas. And so they feel more comfortable with that. But they're putting much less than, where you see somebody's putting all of their net worth in it. They're putting a very, very small portion in. Right. And so saying, hey, I like this deal. I think this may turn out great. But if it doesn't, I'm still going to sleep at night, and I have many other deals that I'm doing as well, and in many other areas. So you're spreading out that risk.
This goes back to your Vegas analogy, right? You never go to Vegas and take more money than you're willing to lose.
Yeah.
Right? Just understanding that it's a red or a black game. Ultimately, that keep going.
No. So that's good. But yeah, I think that's very good to note that it is private placement where you do have issues getting liquidity. And so keep that in mind. So you mentioned this a bit ago, penny stocks with speculation. This I don't feel like is nearly as big of a deal as it used to be. But, used to be you'd get these, they call them pink slips, right? And they'd send everybody these slips and, talk about this company. And what we found is that way back in the day, especially, it was that pump and dump scheme where, you spend a lot of money with the marketing and then get it out. And then what do you know? Who heads for the exits? The owners, and you're stuck holding the bag of nothing.
Yeah, that hasn't changed. It's just moved from basically mailings when you used to get stuff in the mail to now social media, right? Just get on social media, and there's plenty of guys telling you about this crypto or that crypto, and you should invest in it today. Don't miss it going up. Yeah. Always remember there's somebody selling on the other side. In every transaction, just always remember there's a buyer and a seller. They both think they're a genius. Be right back after the break. We'll finish this up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, last segment here, we'll finish up. So we talked a little bit about alternative investments and real estate investments. And again, just, the point is those are two, right? So just understand, again, why you're investing in this. And again, the initial question, why are you so lucky? Right? Again, if you're a uber high net worth guy that can put a couple of $1 million in a deal, that's why people are coming to you. But if you're just the normal kind of, run of the mill average person with some money in the financial markets, and your advisor's coming to you and saying, "Hey, I've got this great alternative investment deal, or I've got this great real estate deal. Why am I so lucky? Why are you coming to me to raise this money?" Because institutions will fund these deals all day long. So ask the question.
Well, the institutions fund them, package them, and then sell them to you at a price.
At a price. Who's making the money? You or them? We also talked a little bit about real estate investment trust, as I said. But there's also Series I bonds, high yield bonds, sector funds. I thought was interesting to be on the list.
Yeah, some of these are really interesting. I mean, I think I bonds are great. I mean, obviously you're not buying them in a portfolio with your advisor or at Fidelity or wherever you hold funds.
I think they're grossly misunderstood, though.
No, I don't disagree. I think a lot of people don't understand them in the sense that, well, we see the great interest rate, but we don't understand that we're not actually physically beating inflation. We're just staying in line with it.
Your return is zero on an I bond.
Well,
over time. And no, this is the part.
Well,
that
your
people
inflation adjusted return.
That's right. Your inflation adjusted.
But nobody's thinking about that. They're just seeing what they're getting.
Yeah, I'm getting this great interest rate. They don't realize that over that time frame, your return is zero. That's the way an I bond works. So on an inflation basis. So, but again, this is why I think that it's probably on the list, is that it's very misunderstood.
Yeah, I think there's a lot of misunderstood investments. And I think the problem with, everything we've talked about right now, extremely subjective. And I know there's somebody who's going to comment probably on the YouTube channel and say, well, I've made my living doing this. Well, great. You're probably the exception to the rule. Mm-hmm. And there's very smart people out there that do exactly that. So we do have to be cautious with that. But, investors we don't understand, I think that's a big problem. And, I visit with a lot of people, and I think, annuities are not on this list. I'm surprised because they get so much grief.
Right.
And I think annuities can be an amazing tool, but almost, I'd say 9 out of 10 times I visit with somebody that has an annuity they've had for years, they don't understand it.
Right.
Like at all.
That they don't
maybe a
understand
little
it.
bit.
They don't understand it, and then it was sold to them. It wasn't. That doesn't even. The annuity doesn't even fit in their financial plan. It's just something that somebody sold to them.
Yeah.
Right. And they bought it because the sales pitch was good.
Correct. And I think that there could be a space for many people to hold those, if done properly and used right. They're just so many times they're just not. And there's a big misunderstanding with that, and that's unfortunate because those can be a great tool.
And the reason it's not on this list is because this article is around an investment portfolio, right? So annuities aren't really thrown into that bucket. Because it's insurance.
Yeah, but they should be as a big part of the financial plan, right? I mean,
they're talking about portfolio management, right? And that's
Correct.
why, to your point, that's why it's not on the list.
Yeah,
Go
exactly.
ahead.
So, I think the investments people don't understand. I think that's really, with any of these, that should be something that if you don't understand it, or the person you're working with cannot explain it to you, then why are we doing it? Right. I don't think you should ever be able to. An advisor should never, quote unquote, sell you something or push you into something that they can't articulate. And that's a problem. I see that often too. Like, well, why'd you do it? Well, it's just going to keep going up. Okay, great. Why?
Yeah.
And I think that's a even if you're wrong, like we've had investments we've been wrong on, we still articulate a good reason on why we believe and why we stand by it.
Right.
Where many people are just like, nope, this is just the way it's going to go.
Yeah. Well, and again, this all goes back down to understanding what you're investing in, why you're investing in it, and then how that fits into your overall portfolio dynamic. And it's like high yield bonds. People buy high yield bonds because they like the yield, right? Oh, this has got a 6% yield, 5% yield, 7% yield, whatever the number is. But it's a high yield bond for a reason. It's got a risk of bankruptcy, right? That's why you're overpaying for the yield. And in the past decade or so, because the Fed has been so involved in kind of juicing the markets and suppressing risk out of the markets, high yield bonds haven't traded at a yield that is relevant to the risk because everybody was piling into these. So again, you were getting a very small spread over risk-free treasuries to buy high-yield junk that was on the verge of going bankrupt. And look, high yield is, we're talking about marketing earlier, marketing speculative penny stocks, etc. High-yield bonds is a marketing term.
Just like extended credit.
Exactly.
I mean, yeah.
High yield. Boy, it's high yield. I want that. I want the high yield. It's a marketing term. What they just don't call it what it really is. Would you, if I came to you and I said, hey, I've got this really good bond for you. It's a high yield bond. What do you think? Oh, I want it. It's a high yield. If I came to you and said, hey, I got this junk bond to sell you, what are you going to buy? Right?
You're like, I don't want that. Who wants junk?
Who wants junk? But that's what a high yield bond is. It's a junk bond. It's got a risk of bankruptcy. So again, if you don't understand it, don't buy it. Go ahead.
Yeah, no, and I that's certainly one on the list. I think that's an important one to understand. That there's always a risk reward factor with any of these investments, and certainly with high yield. And that's one that I think that many people overlook. Not only just thinking of not on the debt or bankruptcy aspect of it, but also on that these things trade like an equity when things get bad. There's a lot of volatility associated with this, where people think and associate bonds with very little volatility. Well, except for last year. And some of this year so far. But for the most part, most people associate, a bad year in bonds is down a couple percent.
Right.
And so you have to understand exactly what you're in. Now, here's one I think that you're going to be able to touch on quite a bit is leveraged ETFs. I mean, how many times do you see somebody that gets in one? Number one, maybe they don't understand it's leveraged, or two, they just have this very high conviction that this is exactly how things are going to go. And then they pile into it and they just see it. We can rationalize markets, but then what we think may happen doesn't happen when it does.
Well, and there's two factors that people miss in leveraged ETFs. So one is the risk. So if the way options work, and these leveraged ETFs are all based on options, which options have a time frame to maturity. And as the option approaches the time frame maturity, it degrades in value. And this is why the worst thing you want to be in is a leveraged fund of anything in a flat market. Because if the market's not going anywhere, that leverage is costing you money. So you actually wind up losing money even if the market is flat. The only way these leveraged things work and really work beneficially to you is that you've got to time the trade. In other words, you can buy it and then the market goes up or down if you're betting on a short market. And it happens immediately, then it will track fairly closely to the index on a very short time frame. But because of what we call the decay of premium, it's the time decay of those option premiums over time. The longer you hold it, the more money you lose. So again, this is just a function that leverage sounds great until it goes against you, because it goes against you twice as fast as it would be otherwise, right? So, if the market goes down 10% and you were long leveraged the market, if you're just long the S&P, you'll lose 10%. But if you're double leveraged, you're going to lose 20% plus the decay of premium. So you wind up losing probably closer to 25% when that option goes against you. So again, it's just incredible. If you're speculating in the markets and you don't care about the losses, go ahead. So that's all on you. But if you're just buying and holding leveraged ETFs, they're going to work against you over time because of simply the way the options work. Go ahead, Dan.
Yeah, so another one on the list was commodities, and I find this one, I understand exactly where they're going with this, because they're saying, look, commodities are typically traded on the futures markets. Most people don't have the expertise to access it, nor to understand exactly what to do. I know some people that do a very good job trading futures.
But key word, they're trading futures. It's a very short term.
Correct. But the other aspect of this is there's other avenues to invest in commodities, right? We can invest in it through mutual funds, ETFs, where you don't have to have that expertise of knowing how to trade them. But so that's one that that's more subjective.
Well, the issue with commodities is the same as leveraged ETFs, though, and this is the key point, which commodities are derivatives. You're not buying a bushel of wheat, sticking it in your garage and going to go sell it to somebody later, right? You're buying an option that has a decay of premium on it. So again, this is actually kind of the same advice with leveraged ETFs. If you buy and hold options, or derivatives over time, you're going to wind up losing money if the price goes against you. So, and it's going to be worse because of what happens with the underlying decay of the option itself or the derivative contract. So again, we just go back to the simple fact that these things can move very quickly against you. I've known commodity traders over the last 30 years. I've never known one that survived long term. Option traders, commodity traders do great for a year or two. They always blow up eventually because of the leverage and the derivatives. And then when things go against them, it goes against them really fast and really bad. So again, we talk about all the oil traders back in 2008. 2020 when oil prices went to zero, wiped out tons of commodity traders. That happens all the time. Commodities are a boom bust cycle.
Well, there's so many geopolitical events, so many other aspects.
Absolutely.
One of my best friends is a commodity trader, does a really good job. But going back to, number one, he understands the market really, really well. Mm-hmm. Number two, he won't get too far over his skis so that if it really goes against him, hey, I can lose today. But you're going to have those days where it just doesn't go your way. You're going to have a month or two, but you've got to understand your risk and understand big picture. And that's the problem, I think, with many people is that they go all in one thing because they have a high conviction, and it goes against them, and they don't have any dry powder to put back in to make this right. So that's the other aspect of this. Last one on the list was individual muni bonds, and I'm not the biggest fan of that one at all, because I do like individual muni bonds. I think there's a lot of good things you can do with them if you understand how to use them, especially if you're in a high income tax bracket.
Well, his point on this one was, again, going back to understanding what you're buying. And a lot of people buy basically junk bond municipal bonds, right?
Yeah.
And while municipal bond defaults are very low, they do happen. And they're also illiquid in that case as well. So again, this goes back to liquidity and safety. Understand what you're investing in. I love municipal bonds. I can't talk enough about them, but we only buy municipal bonds for school districts, for utilities, and much basically stuff people have to pay for, because you'll always get your money back. So, all right, that wraps up the show today. Danny, thank you so much. We'll be back tomorrow, of course, with Michael Leibowitz talking about the upcoming Fed meeting, what that means. Of course, with this recent inflation data, we'll talk about that as well. So we'll see you back here tomorrow on the show. Have a great day.